Hi everyone, and welcome to the first video in Lesson 6, Level 2. We just got finished looking at 5 different options that our company, Ken's Awesome Retail Products, also known as CARP, is considering in order to finance our new subsidiary, Ken's Shoes. The financial group of the company is specifically interested in how the project will affect the cash flow of the parent company, CARP. The cash flow is the amount of money that's flowing into and out of the company each year and is a primary indicator of the overall corporate health. Analyzing our cash flow is important to CARP in order to ensure that it has the funds needed to pay for its day-to-day operations. So in order to estimate the cash flow generated from the shoe project, the financial group needs to combine the revenues and expenses associated with the manufacturing of the shoe with the necessary capital investment or the equipment purchases and financing for that project. Additionally, if CARP chooses to go with one of the 3 options that requires it to go into debt by borrowing money from one of the banks, the cash flow estimate must take into account the periodic payments that must be made to service that loan. Remember, we're going to have to pay $61,000 a quarter for it. We'll have to take that into account somewhere, don't we? The corporate tax code currently allows companies to allocate portions of their capital investment as an expense, as well as deduct interest on any loans. That ends up reducing the amount of taxes that they owe on an individual year. This estimate model has to handle those parts of the overall picture as well. This cash flow model needs to take into account the revenues, the cost of goods sold, the selling expense, and the operating income. All of these factors and a few others that we'll need to calculate need to be considered in order to determine whether or not we have enough evidence to support this project. Out of the 5 options previously discussed, CARP is leaning towards the first option, which was to take out a loan from Fido's bank. If you'll recall, the loan agreement stated that the quarterly payments of just over $61,000 would be made over a 5-year duration. We'll be taking those payments into account when building and then analyzing our cash flow model here. The sales figures here that we have for the next 5 years in our initial model were provided by our marketing group and represent predictions of where they envision the sales and manufacturing costs to be over the next 5 years. We use all of this information to establish the cash flow, but we'll also need to calculate the taxes and depreciation to complete the final picture, as they have a direct bearing on the amount of taxes that we pay each year. As discussed earlier with the loan option, this provides CARP a few tax benefits that will need to be taken care of in order to provide the best possible financial outlook for the future. One of the benefits is that the current tax law allows for interest paid out on a loan to be expensed or deducted from the income of the company. By doing that, CARP won't be taxed on that amount. Let's edit our model here to calculate the interest expense here in this cell. The interest expense is the portion of the payment that's not applied to the principal of the loan amount. This is the amount that the banks receive in order for loaning you the money, and primarily where they make the majority of their money to stay in business. They've got some pretty big buildings. They need to pay for them somehow. This interest amount will vary from year to year, as we'll see in a minute. The amount of each payment that is applied to interest decreases with every payment, and the amount that goes to principal or paying off the loan increases with every payment. If we do this formula correctly in this cell range, the amount will decrease as we go through our 5-year loan window. The standard method of showing the details of this principal and interest interaction is set up and displayed in what's called an amortization schedule or amortization table. The schedule lists for each loan period the remaining principal at that time, the interest paid on that payment, and the amount applied to principal for that individual payment. In this loan sheet here, we've already constructed our amortization schedule and included the specifics of the loan from Fido's bank. As you can see, the original amount of the loan is $1 million.
Here's the plan. We get the warhead and we hold the world ransom for $1 million.
With an APR or annual percentage rate of 8%. It has a duration of 5 years, compounded quarterly, or 4 times a year. This final or ending value of the loan is here in this cell, and it's 0. If there was to be what's referred to as a balloon payment at the end of the loan, that value would be here instead of this 0. This means that for 5 years, we'll have 20 quarterly payments, and that's what we have in this first column down here on the left, from 1 to 20. So each one of these numbers is a period of the loan. In the remaining principal column, we're going to create a formula that shows us how much is left on the loan after each preceding payment. So we'll start with $1 million up here and hopefully end up with $0 down here at the end in the interest payment column. For each quarterly payment, we're going to calculate the amount of each payment that's interest, and in this principal payment column, we're going to calculate the amount that's applied to the principal of the loan, or how much is paid off each period. At the beginning of the loan, the interest payment is going to be higher, and it will decrease as we go down the schedule because we pay interest on the amount of the loan at that point in time. So as we pay down the loan, we pay a little less interest. We'll also see that the principal amount will start lower and slowly climb as we go down the schedule. For every dollar that isn't paid in interest, it goes towards principal. This is known as an amortization schedule. The schedule table will allow us to quickly look at each period and see what's being paid in interest and what's going towards principal, or how much is actually going towards paying off the loan. As we've done before, I'm quickly going to enter the payment function in this cell so we can tell what our quarterly payment is. To begin with, we also know what the starting value of what our remaining principal is going to be. That, of course, will be the reference to our original loan amount of $1 million. Yeah, I know, Dr. Evil does it better. Sorry. Whoa. Now to calculate the interest payment on that first payment shown here in the row as period 1. How much of that $61,000 payment is going towards interest and how much is going towards principal? To calculate the interest payment, there's a very useful function called IPMT, or interest payment. It returns the interest payment for a given period for a loan based on periodic, constant payments and a constant interest rate. The first argument will be the rate, and we know that will be our 8% interest rate up here divided by the number of periods in a year. These cells will need to use mixed referencing, so I'm going to hit the F4 a couple times on each of them to put my dollar signs in the right place just in front of the row. Since we're only dragging it down, we only need to protect the rows. We're not dragging it to the right or the left, so we don't need to put the dollar sign in front of the columns. The second argument is the period. For this cell, the formula will be the cell here containing period 1. That will use relative referencing, so we don't want to hit F4 on this one. Since we're going to want that value to incrementally increase as we drag our completed formula down in a minute, we're not going to put dollar signs anywhere. We want the 1 to turn into a 2, 3, 4, etc. as we drag it down. The third argument is the number of periods over the length of the loan. To get that, we need to multiply the loan duration in years and multiply that by the number of periods in a year. This is going to utilize mixed referencing, so I'll hit F4 a couple times. The fourth argument will be the present value that's going to be our $1 million. Sorry, no more Dr. Evil. Just this cell up here. Let's make it mixed referencing again, locking down that row so it doesn't shift. The fifth argument will be our future value, which will be the ending value of our loan up here in this cell. We'll make it mixed referencing as well. Finally, a 0 here to indicate that the payment is timed at the end of the period. Now when we run this formula, we see that 20,000 of that 61,000 goes towards interest. That means the remaining amount will go towards the principal amount of the loan. To fill in the principal amount, you could do the lazy way, but not the best way of just subtracting the interest payment of that $20,000 from the quarterly payment cell up here. Let's do the right thing instead of just being lucky though. Why don't we use the formula that Excel has been so kind to create for us to calculate the principal payment, PPMT, the principal payment formula. That formula has the exact same arguments as the IPMT function that we used just a minute ago. So if I want to save myself some time and effort, if I go into this interest payment formula and highlight all the content between the two parentheses, and then copy it into memory using Control-C. Now the tricky part that a lot of students forget to do is to hit the escape key here and get out of this formula so we don't mess it up. Now that you're out, now I can start my PPMT formula here in this cell, and then parentheses. Now I'll paste the arguments that are hopefully still in memory by using Control V. Voila! Now close my parentheses, and we should come out with the exact same answer as we had a minute ago using that simple subtraction formula. We do. Cool. Let's move on. That copy and pasting of the guts of a formula that I did a minute ago, it can be a bit tricky, but it also can save you a lot of time, and you know by now that I'm all over that. Now going to the next row, what's the remaining principal going to be at this point in period 2? We can just take the previous principal balance and add the previous principal payment. The reason that I'm adding it is because we already have the negative amount indicated by these parentheses around that 41 grand, so it's a negative number. Now that I have both the interest and principal payment calculations, I can drag down both those formulas down one cell so that I have the formulas all the way across this second payment. Now I can drag all three of these formulas at the same time down through the remaining 20 periods of the loan. As I mentioned before, the interest payment started off pretty high, and slowly but surely it decreases towards zero. As we got towards the end of the loan, conversely, the principal payment starts at around 41 grand and slowly climbs towards the payment amount. So here at the end of the loan, almost all the payment is going towards principal. Looking at our last loan period, I see that we had $51,957 remaining, and that just happens to be the value over here in the principal paid. Coincidence? I think not. Now, if I copy this principal formula down just one more row, we see that we get to an ending balance of 0, so all's right with the world. Now we can see what's going to be applied to interest and what's going to be applied to principal of the loan for each of these 20 periods. Let's sum up these interest and principal payment formulas here just to see how much interest this loan is costing me over the 5 years. That's pretty hefty. What if I shorten the duration to 4 years or 3 years? That might hurt me on my yearly cash flow worksheet over here, as my quarterly loan payments will be much higher, but I'm just curious. If I can afford it, I want to get out of debt as quickly as possible. You'll notice that my formulas break down here after my loan duration of 4 years has expired. If we remember from our Module 5 lessons, we can wrap these formula in an if-error formula so that they don't puke on me after the loan duration ends. So right here in front of these formulas, I'm just going to put in if error, and then at the end, comma, if this formula throws an error, I want 0 to show up. So close my parentheses, copy them down. There we go. Now here's some valuable information. In a short duration loan, this isn't a huge difference between 4 and 5 years. But as you'll find out when and or if you ever plan on taking out a mortgage loan or a house, the amount of interest that you'll pay on a 15-year note as opposed to the more common 30-year note that all the banks want you to buy, the difference is astounding. Hint, if you ever do this math, you'll never want to do a 30-year mortgage. Well, we'll look into all this in further detail here in the next video. So see you then, and go Knowles.